We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us. It's being accepted. I mean, it's not, take home building. I mean, the cost of, we've got 9 home builders, and in addition to our manufactured housing thing, and then operation, which is the largest in the country. So we really do a lot of housing. The costs are just up. Steel costs, just every day, they're going up, and there hasn't yet been, because the wage stuff follows. I mean,
Over the last few months, we are seeing record levels of inflation across the country. As Russia and Ukraine war is still ongoing, the war is having a negative impact on our economy. For example, the price of gasoline is up 74% since the beginning of the year. Other commodities are experiencing similar price increment. On average, price climbed about 8.2%, the fastest pace of inflation since 1982. When the economy gets to this point, the Federal Reserve steps in to cool the economy by increasing prime rate. In September, the Fed increased prime rates by 75 basis points. Just like that, a $450,000 mortgage home gets $1,958 more expensive than before each month. But raising federal fund rates doesn't only affect homeowners. Businesses also borrow money too. When prices get to this high, consumers try to reduce spending or not spend at all. If you couple that with consumers not having spare money to spend, because now they are so focused on saving money, all of a sudden, businesses' sales decline and stock prices of companies takes a fall. But the question is, how we investors protect ourselves from losing money in the stock market? Let's first take a listen to the Oracle of Omaha, Mr. Edward Warren Buffett. The next clip covers 2 important points about how to invest during this period.
The best thing is to have a lot of earning power of your own. If you're the best brain surgeon in town, or even the best lawyer in town, you will retain purchasing power in terms of your income no matter what happens, whether people are using seashells for money or whatever as time goes by. But in the investment world, it's tougher. But Charlie and I think the best answer is to own fine businesses that will be able to price in inflationary terms and will not have huge capital investment that is required to handle the larger dollar volume of sales. Some years ago, I used See's Candy in the annual report as an example of the kind of business that more or less can handle an inflationary world and maintain investment and value no matter what happens to the currency.
Point number 1. The company must have pricing power to offset inflation and require less capital to operate. Point number 2. Increasing your earning power. Let's talk about the first point, pricing power and less capital requirement. Pricing power basically means a business having the ability to raise price without reducing volume units of production. Pricing power is always positive for companies that can sustain it. Maybe a competitive advantage for the company. Raising costs can erode companies' profit margin and ultimately investors' return in inflationary period. Since the company is spending more in production or less product or same volume of product, companies with clear, sustainable pricing power can protect their profit margin by passing those costs to their customers. That is called economic moat, the ability of a company to do things in a way to increase business earnings without a decline in sales. If this isn't done well, then it's going to be a bad move for the company. If raising price isn't a competitive advantage for the company, then obviously the company is going to lose customers, which would have a negative impact on the company's sales. Also, let's not forget, in an inflationary period, companies usually cut down business expense by reducing their workforce and even reduce expenditure on advertisement. This leads us to the next point, increasing your earning power.
The best investment against inflation is to improve your own earning power, your own talents. Very few people maximize their talents. And if you increase your talents, they can't tax it while you're doing it. They can't take it away from you. So if you become more useful in your activities, your profession, doctor, lawyer, whatever it may be, that is the best protection against a currency that might decline at a rapid rate.
Increasing your earning power basically means just investing in yourself to become more useful to your own self. Or if you are self-employed, then you have to build up your own skills to leverage on that set of skills to create more income to support your style of living. But that doesn't just end it. As an investor, there's one important thing most of us disregard when venturing into the investing world. This is commonly not looked at on the part of investors, which is to subscribe to my channel. Yes, that is a nice plugin.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. And that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports, they buy a microwave oven, they do that. They ask people what's the best kind of radar range or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the mobile travel guide, or California. When they go to Europe, they get the Michelin travel guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet. And that's what you get for it. And that's what we were being driven to. And it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting.
The key point here is to understand what you own. A lot of us don't do the necessary check and research to understand the underlying business we are willing to put our money into. What is the economic moat of the company? How good is its balance sheet? And sometimes you should understand the industry that the company operates. And even what is the barrier of entry in that industry? Yeah, barrier of entry, sometimes it is considered as a competitive advantage for some industries. For example, the spaceship industry requires a lot of capital upfront to start. Today, a rocket requires $60 million to build and launch. That isn't the only industry. There are some industries like the mining industry are all capital intensive. These are some of the key factors as investor you need to consider when investing. If you do these things, this would help us make the right decision for the long run. Let's remind ourselves that as a stock market investor, shares or owning an equity in a business can act as a hedge against inflation. In the long run, this means that the monetary value of the stock or share can appreciate over an inflationary period, so that the real wealth is towards the goods and services it can be exchanged for remains constant despite higher prices. Don't forget to subscribe.